Welcome to Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. This week we talk banks, unions, and the heavy hand of Uncle Sam. In the second half of our show, we'll be joined by Rebecca Friedrichs and Terry Pell. Rebecca is a third-grade teacher whose forced union dues litigation has been taken to the Supreme Court by the Center for Individual Rights. Up first, we're pleased to welcome Kyle Hauptman, Executive Director of the Main Street Growth Project and a member of the SEC's Advisory Committee on Small and Emerging Companies. Kyle, welcome to the show.
Thanks a lot, Bill. Great to be here.
Kyle, I asked you on to review the banking landscape, not as it looks from Wall Street, but as it looks from Main Street. But before we get into that, I understand you were a fixed income trader at Lehman Brothers right up to and through its bankruptcy filing in 2008, which does remain the biggest bankruptcy in U.S. history. What did the meltdown look like from your perch?
Well, I hope neither you nor me ever has to go through that again. But I was what's called a money market trader at short end, so we had kind of a front row seat on the whole thing. It was my employer, obviously, and it was an industry-wide crisis, so you're like, I'm going to be unemployed.
And it was the money markets that froze up.
That's right. That was the start of the whole meltdown. You know, once somebody thinks you have a credit problem, you have a credit problem.
Right. The whole counterparty cascade came tumbling down.
That's right. So we got paid partially in stock. No, I don't expect anybody to feel bad for well-paid Wall Street people, which I was.
No, you're not going to get a lot of sympathy from the audience.
That's right. But, you know, as it were, I remember looking for work after that. And they're like, well, you know, what'd your last job pay you? And you got to say, well, part of it was in stock. And how much is Lehman stock right now? It's zero, right? So, you know, they had a 5-year lockup on the stock they gave you. Every year you got paid partially in stock.
Sure. And they're going back to even more of that now with clawbacks.
And I was there 4.5 years, so I never got a cent of any of that. I wasn't in poverty, so I don't want a lot of sympathy.
Right.
But it was terrifying to be part of. It was intellectually kind of interesting. I mean, if you are interested in financial markets, which is why you work in it, fascinating to watch it all happen.
Well, that's why I asked you on. May you live in interesting times was a Chinese curse, and you certainly lived in interesting times.
That's absolutely right.
So what did Lehman do wrong?
Well, there's a lot of blame to go around. Nothing that massive can have just one person to point a finger of. The key thing was that management that got paid a fortune, right? And Lehman management, their job, however messed up government policy is, it is their job to manage that. Lehman management put on too much risk, and they had real estate assets that brought down the whole firm.
So they were genuinely insolvent, not just illiquid.
Yeah, I mean, once someone doesn't know the assets you own, I don't really know your net worth anymore.
If you mark to market, what does that mean in the meltdown?
Especially when they're not even securities. They had actual land in California. So there were whole divisions of a firm that were profitable until the end.
Like AIG went through that too.
Equity trading division was terrific, and then that money now goes to British shareholders with Barclays, who bought them, right? The U.S. portion at least. Whole divisions that were profitable, and all of a sudden there's this other part of the firm where they're buying all these assets that were illiquid, poorly timed, let's say, and it brought down the firm.
So describe the nature of the contagion that required, or at least called forth, so much intervention from Washington.
I can't speak for what was then 26,000 Lehman employees, and then we had thousands of layoffs by the end. But nobody deserves a government bailout. Absolutely not. But it is weird that everybody else got one. And I can tell you right now that the government intervention that happened prior, if you remember, J.P. Morgan Chase earlier that year, bought Bear Stearns in kind of an arranged marriage.
For shotgun
wedding, exactly right. Friday, September 12th, 2008, we were, couldn't do much trading because nobody would take me as a counterparty. We went out to the local pub. I was in Sydney, Australia at the time with Lehman then, and we were the easternmost office.
You woke up first.
We thought that come Monday, we would be Bank of America or Barclays employees.
Sure, and they were working on that.
Those were the rumors going around. I think the Bank of England might have quashed the Barclays merger. Anyway, and it's not because we deserve a bailout, certainly not. But that is what had happened to our friends who work at Bear Stearns.
But it taught the industry and government an unfortunate lesson, which is, oh my God, we better bail out when something goes wrong.
Yeah.
Which is exactly the wrong lesson.
You can argue that maybe, set aside all the policy that was intact, maybe they should have, only because they had even bigger bailouts, which they had to do afterwards, Fannie Freddie, AIG, because of the lack of some sort of Lehman Brothers backstop. And I think it impacted the decision-making of management. That's me speculating. But I think it impacted their decision-making, seeing what had happened to Bear Stearns, and that could have happened to us. And if you think your worst-case scenario is a shotgun marriage with a stable firm, then you're going to make different decisions than you think the worst-case scenario is what it is.
Well, again, let's go through the contagion, because when the dominoes fell, when it went down through Citi and Bank of America and Morgan Stanley and J.P. Morgan and Goldman Sachs, they were not insolvent. They went illiquid. Try to explain the difference.
So I worked in money markets, and that's exactly what it sounds like, which is the market for money in the short term.
Overnight.
Yeah, overnight, could be a week, sometimes up to a year, but usually short term. Companies that are profitable sometimes have short-term cash needs, as we do in our own lives. Even governments that have a balanced budget or run
a payroll
or run a surplus, you do have short-term cash needs. So at the end of the day, there's companies and governments that either have some cash they want to lend out, make a little money on, or you need some cash. And so what I was doing, which is called repo trading, a customer would ask you to buy $100 million worth of bonds, and you buy them from them. So now you have $100 million worth of bonds, but you owe them the next day, in the case of treasuries, $100 million worth of cash. You don't have $100 million worth of cash sitting in a checking account, right? So what you would do is take those bonds and lend them to somebody as collateral and get the money to pay, right? And it was all, A to B. It was, Lehman lending to Morgan Stanley or what have you.
Yeah, most of the counterparty trades are inside a small club.
That's right. Not everybody can participate. So once someone says, wait a second, there's a problem with Lehman, you can try to come out and prove how financially strong you are. But if the market starts to wonder...
Yeah, why take the risk?
Why would you? Just for an example, if I had $1 million worth of bonds, let's say, and I lent it out for $1 million in cash overnight, that sounds like a lot of money. $1 million is a lot of money. But at 2%, which would be a normal repo rate back then, that's $50.
Right.
For one day.
Yeah.
So even if I made it 10%, okay, fine, it's $500, right?
Who wants to make a career-ending move for $500?
Yeah, sorry, 10% would be $250.
Yeah.
So if you're on the other side of that, you say, hey, Lehman's desperate for cash. I lent them money at 5 times the prevailing rate. What'd you get? $200. That's your upside. $200, right?
Right.
And what's your downside? It doesn't get paid back. And why did you have to do that, right? So once people think that you have a problem paying your debts, you by definition have a problem getting cash.
So how did Dodd-Frank solve this problem?
I don't think it did. Two bad things about Dodd-Frank were Dodd and Frank.
Yeah.
Barney Frank was head of the Financial Services Committee. You can go on YouTube. His greatest hits are there saying, in July 2008, Fannie and Freddie are in solid shape.
Oh, he's the roll the dice guy.
That's right. We should roll the dice a little bit and point blank give people loans for they shouldn't have. So, to be the person that says that, it's a resume item. It's like being head of navigation for the Titanic.
Yeah. So the Dodd-Frank law is probably one of the most complex pieces of legislation Congress has ever passed. It's still not done.
Still being implemented 6 years later.
They're writing tens of thousands of pages of implementation regulations underneath it. What impact has this had? First, let's talk about the main money center banks, and then we'll move on to the community banks, which I know is your place of interest. So start with the money center banks. What has all this regulation done to them?
Well, I think if we step back and agree that something had to be done right after that crisis. Now, we can differ on what it was. But Lehman's choices at that point were either bankruptcy, which they went through, or some kind of bailout. And neither one of those were appetizing. I think we all agree on that. What Dodd-Frank did was, instead of amending the bankruptcy law so it could deal with a global interconnected firm, set up what some people call a star chamber, which is a group of regulators, a group of human beings who sit in a room, who decide, when the next Lehman comes around, that when it's time to shoot Old Yeller. Right? They decide, these human beings, and I'm sure they're all terrific, well-meaning public servants, they get to decide.
So it's the rule of men. It's not the rule of law.
That's right. And it has, I don't think, solved many problems. It did go after some of those ridiculous mortgages that were happening then.
But that breadcrumb trail goes back to Fannie and Freddie,
That's right.
Which is still broken, by the way.
But, the no-doc loans and all that. I mean, let's agree, especially if the taxpayer is going to back it, that you should do something about those crazy mortgages back then. The movie The Big Short did do a decent job of doing the whole mortgage trail down to borrowers who know they shouldn't be getting these.
Sure.
But what it did was lay a lot of regulations on people who had nothing to do with the crisis, and this is not even a point of argument. Neither Dodd nor Frank, nor President Obama, who signed the bill, think that local banks were the main reason we had a crisis, or even partially.
Meanwhile, we've cartelized the big money center banks, and we've created an operating environment for the smaller banks that's very challenging.
Right. If I was GM in 1950, I would like it if somebody made it so there'd be no competitors, right? So if you are one of the large banks that is a commercial bank, or a consumer bank, you might call it, that has ATMs, checking accounts, the smaller ones have been hit with all this regulation that's hard for them to handle.
They can't hire 2,000 compliance officers.
That's right. And if you have, Bill Frezza Bank, you got a few branches, and your life is not nearly as good as it used to be, you're going to think about selling that bank, and guess what? You're going to sell that bank for less money than you would have otherwise.
And there goes consolidation, and you're out.
Right. And there's nothing wrong with consolidation in any industry. I don't pretend to know the certain number of banks there should be. But why on earth would the government policy create a fire sale for the largest banks to be able to go up around the country and buy up all these little banks?
Well, the answer most people come up with, it's all the same people going back through the revolving door.
That may be true. But if you want to open up Bill's Bar and Grill and you need a $50,000 loan, that is where community banks came into play. They know the local industries. Where I'm from in Maine, it's the lobster industry. They know the names of the boats and the leasing terms, or it could be fracking or something, or whatever it is, agriculture. When the government sits down in D.C. and says, we're going to sketch out what are good products and bad products, if it's a plain vanilla product, nobody can do plain vanilla as well and as profitably as the big banks can. So why are we quashing the banks that lend to small business?
So, Kyle, your main concern has been not just the small banking community, but the community of small businesses and emerging growth companies that they lend to. Paint us a little picture of what's happened to that climate since the crisis.
The big companies that can borrow money, either from a big bank, and they have a banker that picks up their call in one ring, or you're big enough to issue bonds, right? Only the biggest companies can do that. They've had a terrific recovery.
Oh, especially if the bonds are 2 or 3%.
That's right. Money has been cheap, but not everybody has been able to take advantage of it, including good credit people. So President Obama brags about the S&P 500, as well he should. The stock market's up under his term quite a bit. But those are the largest companies.
And has that money gone into R&D and new products, or has it gone into stock buybacks?
A lot of it's stock buybacks. I'm not going to get into the management and what they do with their money and why they're not expanding, but everybody in the U.S. talks about small business, and most new jobs come from small business.
Sure.
But that needs a caveat, okay? The key thing here is not just that it's small business, it's small new businesses. The existing barbershop doesn't necessarily add a lot of employees.
Right.
But businesses fail all the time. Big businesses, little businesses, they shed. You constantly have to refresh them. Think of a forest and plants dying and new ones, right? When you step on the little plants, you create an environment where the older companies just succeed, and nobody likes competition, right? So the small businesses, that's where job growth comes from. Many of them get their money. They get friends and family, they use their credit cards, whatever, but they get money from local banks.
And these local bankers typically had a lot of discretion. They knew the character of
That's
the lenders.
right.
They knew their family history. That's out the window.
And
with
they don't
Dodd-Frank.
have to say, well, we got to kick it up to management in New York or Charlotte. They can actually make a decision.
Yep.
They're taking the risk. The money they're lending is depositors from the local community.
It's the neighbors.
That's right. And there's a place for that. And there's no reason to artificially quash that. And the reason I care is because of people out of work or who are underemployed, let's say. You want a strong job market. And if you add up the lines, I have the graphs on this. Imagine a line that goes in a V shape way up, right? That is borrowing by big firms. Those are big loans made by big banks. And then imagine another line goes down the same way and goes out in a straight line. Doesn't
flat
recover.
lines.
Now you average those two lines, and what do you get? You get the tepid recovery we've had. And I would say one of the reasons our recovery has lagged historically is because we don't have the new businesses and the new jobs that come with them, and a good chunk of that can be laid at the feet of Dodd-Frank.
So how many new bank charters have been let since Dodd-Frank?
Oh, gosh, virtually none. There was an Amish bank that got started. It's basically zero in 5 years. And community banks have recovered financially a little bit, but if it's a good business, why does nobody want to get in it? Anything else that's a good business, people open up new ones. And the answer is regulation. American Banking Association, there's polls on this. I saw a poll in American Banker magazine and said, why have there been no new charters? 50% of the people said compliance costs. And then another chunk, about a quarter, said it's just easier to buy an existing bank, which I think we can agree those two things are kind of combined, because one of the reasons that it's easy to buy an existing bank is somebody's selling and
They want out.
That's right, because your life isn't what it used to be if you're in charge. And that's who gave Bill's Barbershop a $30,000 loan to open up, and that's what we need more of.
So would a carve-out with some sort of a threshold in Dodd-Frank that said banks who have less than X in capital are exempt, would that solve the problem?
There were a few of those. The Durbin Amendment that limited the fees for debit cards exempted banks under $10 billion. There were some things there. They got a little better FDIC insurance premiums. But I think that they should be exempt straight up from many of the things Dodd-Frank brought in. For example,
Up to a certain size.
Yeah. It's legislation. You got to pick a number. I don't know the proper number. Call it $50 billion to prove which is a real hassle for them and takes time and effort away from their customers, that they don't do prop trading, what they call the Volcker rule.
Right.
No one, again, including Dodd-Frank, Obama, think that prop trading by a little tiny community
It's going to
banks
bring down the nation's economy.
or did before. Meanwhile, it's a hassle for them.
Yeah.
Why make it easiest just for the biggest firms? And again, it's not so much the little banks we care about. It's their customers.
So is this a classic regulatory capture problem?
It sure is. You know how it is. When you sit down and write a law, we saw it with Sarbanes-Oxley that had to be amended later on.
Right.
When D.C. regulators and politicians sit down and write something, who comes out more powerful tends to be D.C. politicians and regulators.
The emerging company that doesn't exist yet doesn't even have a voice at the table.
Yeah. People think of startups as Silicon Valley and the apps on their phone, and that's terrific, and we have a good market for that. I think that could be better too. But the reality is most startups are 0, 1, 2, 3 employees. I say 0 because sometimes you set up the entity first. Is a barbershop, is the corner bakery.
Yeah.
That is where job growth comes from, and that is why we've had a tepid recovery.
So, Kyle, what's this Main Street growth project that you're involved with?
That is my employer, Main Street Growth Project, mainstgrowth.com. You can follow us on Twitter at Main Street Growth, again, Main ST Growth. And we are an advocacy group. We are nonpartisan. We are nonprofit. We are one of many in Washington. And we push for pro-growth, common sense reforms. We push for non-cronyist policies that neither help nor hurt a particular industry or bank. The more complex the regulation, the more it makes the city I'm in right now, Washington, D.C., wealthier, despite producing very little value, to put it mildly. And we try to make life easier for the little guy, which is the checking account customer, who because of regulation now has a monthly fee and has a higher ATM fee and has fewer debit card rewards programs, for example. That's a direct result of Dodd-Frank. We're looking out for the little bank that lends to the small business. I think it's not just policy, and this is a dry topic. I know that when you talk about Dodd-Frank, people think you're talking about a country western duo or something, or you talk about the SEC, people think it's the football conference with Alabama, right? You know, but it is so important to so many people, and I honestly think it impacts the American dream. Who needs job growth the most? Someone who's out of work, someone who's entering the workforce. That is who? Young people. That is recent immigrants. And somebody returning to the workforce, often like, say, a mother going back to work. That is who needs job growth the most. Every time you impede the growth of new businesses via Dodd-Frank and other rules, you are hurting those groups the most. Again, recent immigrants, young people, and people returning to workforce, disproportionately mothers coming back to work.
So you're representing people who generally don't write big checks to politicians or do a lot of campaign bundling. How do you get the time of day in Washington?
Well, it helps that I think we're right.
You think that matters?
Gosh, I hope it does. Call me naive. You wouldn't be the first. But people in Washington, the politicians, represent states and cities that have small banks and small business. And when a small business gets turned down for a loan, they say, Bill, we don't like your barbershop idea. You don't necessarily know that that's because someone in Washington created policy that made that happen, right? When somebody who is a good mortgage prospect gets turned down or has to get a higher interest loan because it doesn't fit with Dodd-Frank calls qualified mortgages, you don't always know that. So we're trying to be the Pied Piper out there, telling people what's going on, saying we can have a better life, we can have better relationships in our communities, including recent immigrants who want to succeed, and when they don't, it's not pretty, right? When policy prevents people from succeeding, it's not pretty. All we're doing is common sense, free enterprise, non-cronyist American dream stuff.
So do you think this will put back pressure, particularly on the representatives from smaller communities?
Yeah, I hope so. And that is our plan. We encourage people to call their legislature, call their senator, call their congressman, email the CFTC, the Fed, the SEC, and say, stop getting Main Street caught in the crossfire. They are paying for other people's sins, and they should not.
Kyle, despite the fact that I've retired from the venture capital business, I still keep half an eye on Silicon Valley, and there's been an explosion of fintech startups and financing of alternative, I wouldn't even call them banks, but alternative lending sources and different ways for consumers and businesses to get access to capital. Do you think that's going to have an impact and maybe pick up some of the slack from the community banks?
Yes, and I would say that our angle at Main Street Growth Project is just making sure that it's a fair fight. If you remember the Uber versus taxi fights, and I, like Bernie Sanders' campaign, uses Uber frequently, the taxi drivers did have one argument that was legit, which is they do have lots of regulation that they have to follow, which maybe is too burdensome, which has been proven to not necessarily even accomplish its goal via safety and that sort of thing.
Right.
Lower prices for the consumer. So they were right about that. What we want to get in front of here is a situation where the banks are prohibited from doing certain activities while they then use their lobbying clout to fight fintech.
Well, the way the fintech guys get around most of those regulations is they don't take consumer deposits. Their source of capital is elsewhere.
That's right. Now, fintech, obviously is short for financial technology, and it does everything from Venmo, which every young person in D.C. uses and elsewhere. It helps make dinner tabs a lot easier. That's sending money. Mm-hmm. You can also keep money in your little Venmo world. I'm not trying to play up Venmo. There's other people in the space. There's a lending money, lending club, that sort of thing. By definition, there's borrowing money. There's investing money with the robo-advisors.
Yep.
And I think technology has influenced many things in our lives, and finances is one of them. We just want to make sure it's a fair fight.
So your recommendation for the Uber world would be, let's relieve the taxi companies of the regulations that won't let them compete.
If those regulations have been proven to not be worth their cost, that's absolutely right. And in a pre-cell phone era, pre-smartphone era, you know what? Maybe you needed all of that extensive licensing, and you had to have companies that all switch shifts at the same time while we're trying to get a cab, right?
Yep.
But we now have data on this sort of thing. And anyway, technology is going to impact all these things as well as it should. We just don't want existing financial firms to feel like they have to come to D.C., pay lobbyists to fight this growing American industry because they're burdened by regulations.
Could you build a small community bank that doesn't take consumer deposits?
It would be difficult because where else would you get your money? Now, you issue bonds, but again, small community banks have lessened the amount of mortgages they do, which used to be very core to them, because cookie-cutter mortgages are best done by the big firms.
Right.
What they still survive and do is small business loans, which is why we would rather have money spent not on a new compliance officer, but actually lent out to fill a vacant storefront on your town's main street.
But consumers have so many choices now of where to put their money.
They
You
sure do.
don't have to go to the local bank branch. You can put your money not anywhere in the world, but certainly anywhere in the United States. Is there really a need for the depositor side of community banks anymore?
Well, your paycheck has to go somewhere, and it can go into a brokerage account, a money market account, that kind of thing. It could go into something we don't even use right now. But at the end of the day, the financial system is just to allocate capital. You and I don't spend every cent of our paycheck, let's say, and there's $100 left. That $100 becomes somebody else's mortgage. It becomes somebody else's small business loan. It's just to allocate capital. Whether we do it by walking in a branch or whether we do it online doesn't make a difference. Most banks have technology anyway. You can deposit checks online. You can do various things. But we do have a need to have a functioning, cronyist-free financial system that has true market discipline, not just regulatory discipline, true market discipline to make it work. I am privileged to be a member of the SEC's Advisory Committee on Small Business, Small and Emerging Business it's called. And we deal with this crowdfunding issues.
Sure.
It is neat and something that could not have happened when we were kids, that you can online have $5,000 and lend $500 each to 10 different new companies.
Let's see what happens.
And you can be a venture capitalist, and you don't have to be a one percenter. You don't have to know the person at the venture capital firm. Why let them have all the fun, right? There's a beautiful democratization that can happen in this country and in others if we let our regulatory system keep pace with technology and allow the free enterprise system to thrive.
Well, Kyle, on that note, I'd like to thank you for coming on the show, and good luck with your efforts.
Great to be here. I'll be here anytime you like.
That was Kyle Hauptman from the Main Street Growth Project here on Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. You can check out Real Clear Radio Hour on Facebook or follow us on Twitter at Real Clear Frezza. And while you're at it, take a look at realclearmarkets.com, my go-to place for diverse views on political economics. We'd like to thank our long-term sponsor, Old Boston Restorations, for their support. Old Boston is a boutique property management company in Boston's South End. Ahead, we'll speak with teacher Rebecca Friedrichs and attorney Terry Pell, whose forced union dues case, now sitting in the Supreme Court, will potentially overturn restrictive labor laws in 23 states. Stay tuned.